Yeah, so I'll give you a quick overview of what BDC does in the venture capital area. We've been doing venture capital, actually one of the first institutions to do venture capital in Canada. We started back in 75, and they got more formalized in the early 80s with a dedicated fund, which they initially capitalized at, I think, around 45 million. And the current fund now is all-encompassing about 700 million. We're predominantly an early stage investor or a seed investor, and what that means is we'll invest in anything from something that's coming out of the university that has no management around it, is essentially a concept, to something a bit more formalized where there is a management team and they're looking to do their first institutional round of venture capital, and that's where we sort of come in. Some basic criteria of what we look at: a proprietary position, something that has very rapid growth, a strong competitive advantage, solving a global problem, not a local problem. We operate under two different investment models. We either invest direct, which is the area I'm in, so we'll put equity into a company directly, or we'll invest in other venture capital funds in Canada that are specialized, and that's really to help facilitate the whole venture capital industry in Canada. We focus on the main technology platforms in Canada, so IT, life sciences, telecom, and then we have an area of clean tech, and then within the clean tech we kind of lump some other sort of platforms, electronics, environment, etc. We currently have about 140 companies that are active in a portfolio, or have a portfolio that has committed capital of about $500 million. And then we do a number of other venture capital funds. As I mentioned, we have 19 funds with committed capital about 250. And then we have people across Canada from Vancouver, Calgary, Toronto, Ottawa, and Montreal. So our investment amount, so if we're doing a very early stage company, we'll do $500,000, 250,000, up to 3 to 4 million as a first investment. Over a lifetime of a company, we can go up to 10 to 12 million, but that's typically after we've been in for 4 or 5 years. There's multiple rounds and things are going successfully. On average, these days we probably have about 6 to 8 million in a company. We prefer to invest with a syndicate, so other venture capital funds, except for the early stage or seed stuff where we'll go in by ourselves, because there just are very few players in that space to begin with, so we will go in initially. We've co-invested with essentially every other venture capital fund in Calgary, or in Canada, and many out of the US and Europe as well. We are very patient capital. Our time horizon is anywhere from 5 to 12 years. Our average age of our current portfolio is probably about 8 years. Not exactly what we want, but given market conditions, that's where it's at. And we have the ability to follow on, so we just don't put in one investment and then that's it. We're there for the full term, whether there's multiple rounds. If things get difficult and the company needs money, we will continue. We've had some good success stories over the years, everything from Ballard, Creo, Tundra, some life sciences one. Oncogenics is our most recent one. And over the next 3 years, or actually the next 2 years now, we expect to invest a total of 260 million. Most of that will be in the direct fund, with some going into the fund of funds. When it comes to energy, where do we focus? We focus mainly on the clean tech or the environment side of that space. We're looking for companies that have a competitive advantage, that rely on technology mostly. We want, as I mentioned before, we want companies that solve a global issue. We're looking at very big markets, and the only way you get big markets is if you're looking at global problems, not local problems. Again, we want something that is in a market that's unsubsidized. The reason I keep looking back, because I do life sciences, and I had to ask the people from our energy team, what do they look at? And what they want to see is something that's scalable. So something that doesn't cost $100 million, to go from the bench to a scalable product. There's just not enough capital around to do that kind of stuff, and they want a capital efficient model. So over the lifetime of a company, they want to see at least 25 to 50 million going in, because that's pretty much what the Canadian sort of environment can tolerate these days. Where don't they focus? They don't do any exploration. I think that's in our mandate. We're just not allowed to do it. They don't do biofuel facilities or any of this waste to energy plays where there's a lot of capital infrastructure that's required. That's just not the space we do. Our primary focus is investing in working capital and R&D. And as I mentioned, they don't do large, expensive infrastructure plays. So what's the current environment like these days? It's for early stage venture capital, it's very challenging across all the sectors, where it's life sciences, telecom, or IT. Probably it's a bit better in clean tech, because that seems to be the more hot space these days. The biggest problem that the industry is facing is low returns, mainly because there's no exits. The IPO market has been closed for a number of years, and it wasn't that great before the global financial crisis. Now it's even worse. So that's knocking down returns, and if there's no returns, there's no one going into this asset class, from as far as the pension funds and endowment funds. So the amount of venture capital in Canada is dropping, and the amount of venture capital globally is dropping. Historically, we've always relied on a hold time of 3 to 7 years. That's shifted out. We're now thinking that a lot of the companies we will probably hold up to some of them for 12 years because there's just no exit opportunities. There's no IPOs, and there is a M&A market, but for the most part, the buyers know it's a buyer's market. They know there's a lot of early stage companies out there in difficulty, and they can set the price. And the ones that aren't able to play in the M&A market, they can't play because they're still hurting. A lot of the big corporations out there are still hurting because of the whole global financial crisis, so they're not buying as well. The problem with a lot of the companies is the financial risk. Historically, raising additional money didn't take that long. In the current market, it's taking a lot more time, and companies have to allocate more resources to raising money. So it means they have to take resources away from doing their R&D. They go a lot more into stopping and starting because they raise some money, then they see it running out, so they cut the burn rate down. They slow things down until they raise more money, then they staff back up, and it's a cycle now that it's much more difficult for these companies because the financial risk is so high for them. And I've mentioned about the buyers; they're still distracted from the global financial crisis. A lot of companies, I think we're coming to the end of sort of this global financial crisis, so a lot of companies have survived, barely, but now what? Now they need to go out and try to raise money, so they managed to survive, but now they don't have the money, so it's a real challenge. I know a lot of the companies that we have money in, they're really trying to figure out where to go to next. How do they readjust their whole business model on this? They've all delayed hiring people because they're trying to save money, so you don't have the right people. You're trying to hire cheap people or the wrong people, and it's creating a lot more problems. So it's a very challenging. It's stressful on management. The CEOs are really having a hard time dealing with this. And that's it.